we may actually have a soft landing, but the economy could actually contract because when you look at these Western economies turning over, it's not a good situation.
Today we have Chamath on the All In podcast, expressing his concerns about the current state of the economy and why financial markets are in for a rude awakening. He also points out the UK's economic troubles and why we're seeing a breakdown of their financial system as well. With the 2023 implications for the banking system we've seen a preview of already, Chamath says a credit crunch is coming next. He emphasizes that industries reliant on credit, such as real estate, will continue to face challenges this year. He also discusses the Federal Reserve's intervention to save the banking system, which is creating distortions as interest rates continue to climb and printing resumes. If interest rates don't decrease in the next 18 to 24 months, Chamath says heavily leveraged companies will reap the consequences of breaching the debt covenants they hold, which presents a major problem in many sectors of the market. Let's get right into the latest interview with Chamath, as he gives his market prediction for 2023 and what the economy can expect in the last half of the year. Don't forget to share your thoughts and comments down below, and leave a like if you enjoy the content we do here. Let's get right into the video.
I think the Eurozone, quite honestly, is probably a quarter into a recession already. So, we have 6 or 7 of the really important countries probably in a recession. The UK in really big trouble. The US relatively keeping things, in a pretty good place. China economically, I don't know where the demand is going to come from. On the same time that their internal demand is imploding, they're creating all these export controls that I think are not going to actually help them solve the problem, because it just accelerates Western economies' desire to delever from China. So the whole setup, I think, is a very complicated one, but the US looks really good, frankly.
But think about our situation. We still have an inverted yield curve. It's the most inverted it's been. I think this is the longest it's been inverted. Now the Fed is signaling that we're going to get 2 or 3 more quarter point rate hikes. So it's about to become even more inverted. And what that does is it puts incredible pressure on the banking system, because the whole banking business model is to borrow short, which is from depositors, and lend long. And if short rates are higher than long rates, that whole business model doesn't work. So either they can't engage in lending activities, meaning there's a credit crunch, or deposits just leave the system. And that's happening too. So any business out there that's dependent on credit, the real estate industry or auto industry, any industry that depends on loans and credit, they're going to continue to be hammered by this. Here's the thing, is that the Fed engaged in an extraordinary intervention a few months ago to save the banking system with the Bank Term Funding Program, right? Where they basically said to all the banks that if you have US Treasuries, and I think it also applied to mortgage-backed securities as well, we will basically take all of those assets and give you par value. We'll give you 100 cents on the dollar.
Yeah.
In exchange for, I guess the bank would have to pay I think it was the 12-month interest rate with like 10 basis points or something like that. But the Fed did engage in a huge intervention to save the banking system, and they may not be done with that yet.
You guys,
so I just wonder,
yeah.
I just wonder if you didn't have all of these distortions, what would the real shape of the economy be? Another one on the fiscal side, on the fiscal side was the whole Biden's energy bill. Yeah. Which was supposed to be $350 billion, but as our energy investor friends are saying, it's probably going to be more like $1 trillion when they add it all up.
No, but that's honestly, hold on. Those guys are being hyperbolic, and they're just stupid and wrong, because I know which friends they are, and I know them to be mostly stupid and mostly wrong most of the time. Look, the good thing to know about—
oh my God, I'm gonna get a text after this.
Well, yeah, you should, because he doesn't know what he's talking about, and he keeps saying
there's a lot of stimulus is the point, whether it's $500 million, sorry, $500 billion or $1 trillion.
He's just talking his book. But where can I just go back to where you're fundamentally right, and where I think both of us can be in unison on this, which is there is a looming credit crisis in the United States. And I tweeted something a few weeks ago, but the debt wall that corporate America is about to hit is pretty meaningful. And a lot of these companies will have to thread a needle, because if rates don't go down materially in the next 18 to 24 months, these folks are going to be paying rates that they cannot bear, and they'll probably they'll breach a covenant of some of the debt. So, one thing that's important here is that there's some very strict guidelines and covenants that debt issuers sign up for. And one of them is, how much debt can I have as a percentage or as a multiple of my EBITDA? And so that's the way that bondholders govern the risk that you don't overborrow. Now, the problem is if you have a ratings, an earnings recession and or rates go up, you can get one of these two things to go wrong. And all of a sudden now you have 7 or 8 times your EBITDA and you're in a very, very bad state. So I do think that that's possible. But at the same time, I don't think that that's a calamity that touches the entire economy. I think there are a whole portfolio of overlevered companies in real estate, and there's a whole portfolio of overlevered companies in private equity. Those folks will have to get recapped, and that will probably cost trillions of dollars of capital impairment. But I do think that that can relatively be done without impairing the economy writ large.
I mean, you've said we're going to see rates stay high for a very long period of time.
Yeah, I mean, I think I've said this for the last few weeks, so I'll just say it again. But I think that it's there's no hard landing, right? That's the hard landing was sort of the Druckenmiller thing that I think that, I said, I think it was a few weeks ago. It's very difficult to see a hard landing when China stimulates, just because of their natural gravitational pull in the world economy. When you look at inflation, we've done the best job of the developed nations in getting this thing under control. And so I think now it's just about making sure that we adequately contract the money supply and making sure that we have bullets in the chamber in case things get bad. What do I mean? When you look at this chart, the thing that I think about is I'm glad rates are almost at 6%. Why? Because when you look at the UK, Italy, Germany, most of the Euro area, France, Japan, and then, China, it's non-existent, but China has a different issue. The reality is that, a pretty bad set of economic circumstances could actually touch the Western developed nations if you start to see some of these countries rip rates higher to like 7, 8, 9%. The UK, it seems like, I don't know what you guys think, it's definitely going to 7. And it could go to 8. I mean, it could be a very bad situation for the UK. They're in a lot of trouble. And so I think it's important that the Federal Reserve have tools. So by continuing to constrict the money supply, have rates that are relatively elevated, maybe a quarter or two longer than they need to, it gives them a lot of positive optionality if they need to step in if something bad really happens.
Chamath expresses confidence in China's ability to stimulate its economy, considering its significant influence on global markets. He notes that inflation has been well managed in developed nations, emphasizing the need to control the money supply. Chamath also welcomes the relatively high interest rates in the United States compared to other Western countries, which could potentially face economic challenges if rates rise significantly. He specifically highlights concerns about the troubled situation in the UK and emphasizes the importance of the Federal Reserve having tools and elevated rates for a longer period to provide flexibility in case of emergencies. Chamath does believe that the broader economy can manage potential capital impairment and maintain stability even in the face of an impending recession. What do you think about the latest interview with Chamath and the All In podcast? And how will the US economy stand up to more countries now moving away from the dollar? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this. We'll see you in the next video.